Good evening, ladies and gentlemen. This is Barry Norman on behalf of VTX, and welcome to our class on support and resistance. Now, ETX is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. And for those of you joining us through the internet tonight and don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority. And beginning January the 4th of this year, binary options are now also a regulated product. So everything that you trade on our platform is regulated by the FCA. And we're also a member firm of the London Stock Exchange. When you trade with ETX, you have many different choices, whether you want to trade on our ETX binary options platform, or our MT4 downloadable platform, or our all-new ETX Trader Pro. It's up to you to decide, and all you have to do is contact customer support, and we'll get you set up on one of them, all of them. You can trade any which way you wish when you're with ETX. So tonight, we're going to be talking about support and resistance for CFDs and Forex trading, as well as cryptocurrencies. Now, despite all the fancy and exotic tools it employs, technical analysis really just studies supply and demand in the market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the market by studying the market itself as opposed to its components. If you understand the benefits and limitations of technical analysis, it can give you a new set of tools and skills that will enable you to be a better trader. So one of the most important concepts that a trader must master, no matter what type of strategy you're trading for, there are certain building blocks that are your foundation. Reading a chart, putting trend lines on a chart, and isolating or developing support and resistance zones, or support and resistance lines. Now, support and resistance is a common jargon for areas in a chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. Knowing where these levels are makes it easier to decide when to open and close trades and how we can locate these prices to begin with. Now, support and resistance are almost the exact opposite of each other, but support can become resistance and resistance can become support. Now, support and resistance can have numerous applications and can be identified in many different ways. Traders can use support and resistance identification for managing risk in a strategy. Traders can also use support and resistance to grade market conditions and enter positions. And one of the more difficult concepts with technical analysis is grasping this premise of support and resistance. There are numerous ways to identify these levels, and even after identified, there's a plethora of ways to integrate them and trade with them. So one of the best reasons to learn how to read a chart is so that you can properly apply basic technical analysis. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you're using. Now, the reason that support and resistance are so critically important Regardless of what strategy, no matter how you're trading in the markets, no matter what you're using for your decision-making capacity, if you think of support and resistance levels like the rungs on a ladder, and as price moves through these rungs, you can predict where the next step will be. Okay, so whether you're using it to make trading decisions or you're just using it as a guide along your, once you've entered a trade or when you should exit a trade, it will help you make smart decisions. Now, support describes a price level that an asset tried to cross below but ultimately stayed above. Resistance describes a price level that an asset tried to cross above but could not. The bare minimum requirement to draw a support line or resistance line is that the asset must spend a significant amount of time or volume at that price level. Now, one of the ways that I describe or try to explain this concept of support and resistance, because it's not very difficult, is by the use of an elevator. Now, if you imagine that I painted you gold and I painted across your chest 1250, because that's what hypothetically gold was trading at today. Now, gold has no hands, so you can't touch any buttons in the elevator. When you're in that elevator, what happens? The floor below your feet is supporting you, correct? And if you want to move upward, you need to break through that ceiling above your head, which is your resistance. Now, if you were in an elevator that was moving down, it would be just the opposite. You'd have to break through that floor. So support and resistance are just the opposite, whether if price is moving up or price is moving down. Now, since you don't have any hands and you can't push any buttons, you would have to make some type of an evaluation as to what the next floor or the next level would be where the door to that elevator would open. No different than the movements of an asset. So let's say today, when we pushed you into that elevator, you noticed that you were in a 4-story building. You noticed that on the ground level, there were some coffee shops, you know, a little sandwich shop, a couple women's boutiques, a little, 24-hour, get whatever you need shop. And the rest of the building was high-end offices. So as you're standing on this elevator and the elevator moves up and the doors open, you notice on the first floor that is doctors' offices, lawyers' offices, accountants' office, professional space. The door closes and moves up to the next level, and you see more of the same thing. The door closes again and moves up to the next level, and you see it's conference rooms. And you can see all conference room 1, conference room 2, and you see the schedules. The door closes again, and it opens up on the roof deck, and it's a great big roof deck for smoking. There's coffee machines up there. There's a couple vending machines. There's nice tables and chairs. So you assume also a lot of the employees will come up here and eat lunch. But what have you just done? You've made some analysis of the building or the market. Now, if you can combine that with the time of day, you could then make some predictions. So for instance, the elevator's on the ground level, and it's 8:30 or 9 o'clock in the morning. Most likely then when that elevator fills up with people, it's going to go to the first and the second floor. And then go back down to the ground level and fill up with more because it's time for people to be coming to work. Now, if it stops on the first or second floor and somebody gets on that elevator, most likely it's going to go up to the roof deck because that's probably somebody who came in early and wants to go smoke. Because you notice when it stopped at the conference rooms, that there was no conferences scheduled till the afternoon. So there's really no reason that elevator is going to stop between 9 and 10 on that third floor. Now you also know probably around 12, 1 o'clock, that elevator is going to make lots of trips from the first and the second floor up to the rooftop. It's also going to make a lot of stops from the first and second floor come right back down to the ground because lots of the employees will be going out to lunch. So what you've done is you've analyzed the market and the price movement and determined these levels of support and resistance where this elevator should stop and go. So defining the concept of support and resistance is fairly simple. When discussing the context of a stock market, it defines the level at which buyers and sellers step into the market or where the law of supply and demand comes into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelmingly high number of buyers step into the market, an indication of support is being put into the market. Conversely, a large number of sellers indicates that there's an overhead resistance preventing the asset from moving higher. The price level which creates support and resistance in an asset only tell half the story. We mentioned the key phrase above, overwhelmingly high. Volume is the second half of the equation. It shows us the strength behind the selling and buying at support and resistance levels. The stronger they're buying or selling at a support level the resistance level, the more important of a signal is being given. So again, let's go back to the elevator, and the elevator fills up with people. So there's a good probability it's going to stop at the first floor and then the second floor. But imagine if the elevator only had 1 or 2 people on it. Maybe it's not going to stop at the first floor at all. Maybe those people are just going to the second. Or maybe they're repair people going up to the conference room floor. The odds and probabilities change depending on how many people are in that elevator or what the volume is. Now, we also have things like blow-off tops and panic sell-offs that can be tops and bottoms in the market and mark important support and resistance levels of an asset. An increasing popular technique for determining support and resistance can be derived through the use of Fibonacci levels. These levels are viewed by some as imaginary levels, but have now developed a strong significance due to their widespread use. It's almost a self-fulfilling prophecy, which causes prices to stop and reverse at these levels. So let's go over and take a look at some charts and see what we're talking about in real life. Okay, what we're looking at now, right now on this chart, you're looking at the Euro US dollar. Now, I'm using this chart on TradingView. We could be on the ETX Pro platform looking at the Euro US dollar also right here. As you notice, it does this, it's moving in the same direction. And on the ETX platform, we can put pivot points or support and resistance levels right on our charts by simply clicking under our technical analysis tools and adding those on by clicking pivot points. Pivot points is one of the standard ways of getting support and resistance. Pivot points come from what's called a pivot point chart. Now you can get these on all technical analysis sites. They're not customized and they're not unique. The numbers are available to all of us and they're the same numbers. Okay. They're done with a calculation using price movement, opens, highs, lows, and closes. So we can see right now on investing.com is what I'm using, but you can use any technical analysis site, or you can use a pivot point calculator, and it's just a simple calculator. You put in all the numbers and it'll do the calculations for you. But this is going to give us the levels above and below the current price of the asset. We also can do that on the ETX Pro platform by just clicking on pivot points, and it will drop them on our charts for us automatically. But as we can see here, the current pivot points, the current support and resistance level for the Euro US dollar is 123.79 and 123.99. Now these numbers are continually calculated based on price movement. So imagine it's just like the floors and the ceilings in the elevator. By knowing the time of day the people are moving in and out, you get very defined points of support and resistance and how well, what floor it should stop at. So as you can see, they're already on the chart here on the ETX Pro platform because we can just click on pivot points and it will put them on here. On my chart here, you can see all the blue and the red lines. These are previous support and resistance levels as prices move through its recent trajectory. And these price points, these support and resistance levels do not become invalid. They're just not useful at this price. So right now we're going to go draw a line on this chart at the 123.79 level, which was the price point, the resistance line that we got from the pivot points. And let's make it yellow. And then we're going to do our resistance line at 123.99. And we have our current support and resistance levels, or our floor and our ceiling above where the price is at the moment. So imagine when price is moving up today, this was the elevator moving up and down, or this is how the elevator moved most recently, straight up to the roof deck. And this is where it's staying. But by combining support and resistance, simple things like trend lines and moving averages, we have the basis of a trading system. Now we also see as prices moved up and broken through this last resistance line, look at where volume has been going. Volume's been steadily increasing along with price. So this tells us a simple little story about what's happening with the euro US dollar. We can also see here on this chart for Bitcoin, all the different levels as Bitcoin has been moving up that we have isolated. Now these have been isolated as support and resistance levels using swing lows and swing highs. Another way to come up with support and resistance levels. There's another way, a third way, which I call eyeballing. And eyeballing for me is simply going back using my eyeballs and looking at how prices move when it was in this price area at a previous time. And we just go back through the charts and look to find the last time and the time before that the euro was trading at this level. And we look to see what price levels were significant in the past. And eyeballing to me is a great way of finding important support and resistance levels, because at the same time, it gets you very familiar with how price is moving on the charts. So if we were to change this chart, say to a one-day chart, so it'll take us back farther, we can see that the euro hasn't been at this level in quite some time. So therefore, we're going to have to go back pretty far to find how it was trading in the past. Now we can see that back in 2014, the euro was trading at this price level against the dollar. It's been quite some time since it was in the 123, 124 level. And what we can do is isolate tops and bottoms in that price trade range to see what prices were significantly important at that point. And then bring those prices forward onto today's charts. So let's go back to my PowerPoint for a second. Okay. Now, support and resistance indicators are indicators are a great addition when looking at support and resistance levels. This is because the indicator will act as another form of validating that the security is approaching a support and resistance level. Since support and resistance levels act in cyclical fashion, meaning the price will bounce off of the highs and lows of the range, oscillators are best fit. Oscillators like support and resistance levels will bounce from one extreme to the next. RSI and stochastics are great when you have a trending market breaking through support and resistance. So let's go back to the chart and let's drop RSI on here. And look at this, we see that price has surged above the resistance level, volume is up, and look at where our oscillator is trading. It's way above its 70 level, way into its overbought zone. Okay, so once it hit the overbought zone, it's telling us there's too many buyers, of the weight of the euro is too heavy. It's telling us that this trend will most likely end, but we haven't seen any indication of that yet. Okay, so it's warning us ahead of time. So we've got a combination of a lot of things. Now, our moving averages haven't crossed over. They crossed over way back here when the uptrend started, but they're still pretty well separated, so they're not giving us a signal to exit the market. Our trend line is still offering support. Our volume is still holding up, but RSI is kind of giving us a warning. So maybe we wouldn't want to enter the market at a buy position, and maybe we'd want to be looking for a sell opportunity that the market, when it's telling us the market, the uptrend is about to end. So we don't know at this point, but it's giving us some type of a warning when we combine it together here. Now, support and resistance represent key junctures where the force of supply and demand meet. In the financial markets, prices are driven by excessive supply or demand. Supply is synonymous with bearish and selling. Demand is synonymous with bullish or buying, bulls and buying. These terms are used interchangeably throughout this and other articles. As demand increases, prices advance, and as supply increases, prices decline. When supply and demand are equal, prices move sideways as bulls and bears slug it out for control. So what exactly is support? Support is the price level in which demand is thought to be strong enough to prevent the price from declining further. The logic dictates that as price declines towards support and gets cheaper, buyers become more inclined to buy. So what we have here again is, by understanding these levels of support and resistance, here we see the euro being pushed way up. Okay, also what happens when price rises like that, the buyers are less inclined to buy because they don't want to buy at tops. So they're going to look for the price to ease back down to a level of support, which will probably be this 123.70, and then the buyers might re-enter the market. So this is the point where we will probably decide whether we have an overbought situation or a simple retracement. We want to see whether the buyers are going to re-enter at a lower price and then drive the price back farther up. And all of this is done by using support and resistance. So support does not always hold, and a break below support signals that bears have won out over the bulls. A decline below support indicates a new willingness to sell or a lack of incentive to buy. Support breaks and new lows signal that sellers have reduced their expectation and are willing to sell at even lower prices. In addition, buyers could be coerced into buying until prices decline below support or below the previous low. Once support is broken, another support level will have to be established at a lower level. Support levels are usually below the current price, but it is not uncommon for security to trade at or near its support level. Now remember, technical analysis is not an exact science, and it's sometimes difficult to set exact support levels. In addition, price movements can be volatile and dip below support briefly. Resistance now is the exact opposite. Resistance is the price level at which selling is thought to be strong enough to prevent the price from rising any farther. Resistance does not always hold or break above resistance signals. So again, if you just have in mind, as price is moving up, support is the floor below your feet and resistance is the ceiling you have to break through. When price is falling, it becomes the reverse. Now, when price is moving up, that floor that's holding you up is pushing you through that ceiling, which is your resistance. When you break through that ceiling, what happens to it? It becomes your new floor. So these floors and ceilings can reverse themselves and can become the opposite. So in other words, support equals resistance. Another principle of technical analysis stipulates that support can turn into resistance and vice versa. Once the price breaks below a support level, the broken support level can turn into resistance. The break of support signals that the forces of supply have overcome the forces of demand. Therefore, if the price returns to this level, there's likely to be an increase in supply and hence resistance. So as we can see here in this chart of the NASDAQ, we saw price bounce up and come up to its resistance, back down to its support level, bounce back up to its resistance level, come back down to support, and then it eventually broke that support level and came back down. As price moved back up at a later time, that old support level became the resistance level. Price bounced back up, it came back up to that resistance level, fell back down, but then it broke through, and now that resistance level became its new support level. Okay, but these can only be crucial levels. You know, price has lots of different support and resistance levels. Some are major support levels, some are minor. Some have lots of history where the price has repeated itself over and over at that point. Okay. When you're looking at these longer term major support levels, they become resistance to support. Minor levels, as price moves through, are just stepping stones. Again, they're the steps on a ladder. So tips for using support and resistance levels. One, watch for breakouts. As we noted above, price can and do cross the support and resistance levels on the way to forming new trend lines. Use the current levels as a guide, but realize that they will change over time. Think of the changes as opportunities to make profit. Two, when charting the price action of an asset, expect to see at least 2 price bounces before considering any high or low to be a resistance or support level. Preferably, you want to see 3 bounces since each one strengthens the signal. 3, asset prices tend to test support and resistance. Now, a price can move directly through a level of support and resistance. Okay, there's no law that it has to stop. But if you've correctly defined your major support and resistance levels, you'll find that these are areas where price has a difficult time breaking through and you'll get congestion. So when you look for these the primary levels, you want to look for the more times that prices touch that level. And you'll find that price will approach that level, bounce off it, approach that level, bounce off it. It can eventually go right through that level. But most likely the markets will keep testing that level. so you can calm your nerves and learn to trust your charts. When a breakout occurs, it usually does so in the context of forming a new price trend. Your chart should give you a heads up about that in advance. Now, don't get lazy with your charts. The more you trade a particular asset, the more you'll feel as if you know how its price will move. Be warned that binary options especially have a way of surprising even the most experienced traders. Intuition is important, but tracking price action, keeping accurate charts, and collecting reliable data are much more. So if any of the above concepts seem complex and confusing, don't worry. With time, you'll be able to find that they are actually simple to understand and apply. Most of the complexity is due to the lack of familiarity. Resistance is not just some random area where price turns around. There are potential sellers, traders who have sold a Forex currency pair once before and remember that the collective power they have had to push price lower. There are also buyers who went long at support and were disappointed that price did not go higher and will close their buying position with sell orders at a price called resistance. So imagine if you were gold again and we painted you 1250 and you knew that gold had a very important rooftop level at 1265. Okay. You would most likely put your take profit point at 1266, 1267. So as price is moving up in that direction and it breaks above that important resistance level and hits that support level, you're most likely going to sell and take your profit. Well, so are a million other buyers, so the price will ease back down. Now, if that price is meant to continue up, the buyers will re-enter the market because maybe you had set a buy order just above that next resistance level. So if it broke that resistance level to continue moving up, you would want to enter more buys. A seller might have put a sell order in at 1264. So if it bounces off that resistance level and starts moving back down, he's going to sell down at 1264. So these are understanding those levels and understanding what happens at these levels can help you understand what is taking place. Now, like I said earlier, my favorite way is eyeballing. It's my first step because technical analysis is not an exact science. It's useful to create support and resistance zones. Each security has its own characteristics, and analysis should reflect the intricacies of the security. Sometimes exact support and resistance levels are best, and sometimes zones work better. Generally, the tighter the range, the more exact the level. If the trading range spans less than 2 months and the price range is relatively tight, then the more exact support and resistance levels are best suited. When you're trading in day trading, you want very specific tight zones around your price, but you also want to know where those major zones are. Okay. And so sometimes it's best to fill in and call it a zone between your major and your minor because it's too close together to actually enter or exit the market. So I call them sometimes Deadman Zones. When the price falls between this major and the minor, or if I'm using Fibonacci levels combined with eyeballing, combined with pivot points, it might give me this little ribbon of price, and I can call that a zone and make that my Deadman zone. So identification of key support and resistance levels is an essential ingredient to successful trade technical analysis. Even though it's sometimes difficult to establish exact support and resistance levels, being aware of their existence and location can greatly enhance analysis and forecasting abilities. If a security is approaching an important support level, it can serve as an alert to be extra vigilant in looking for signs to increased buying pressure and a potential reversal. If security is approaching an resistance level, it can act as an alert to look for signs of increased selling pressure. Another great way to find support and resistance is to mark levels in the past where prices had a difficult time breaking through. As price moves up and down each level that prices bounce off of could be a significant level in the future. Now, this is manually intensive, but you can do it by identifying swing highs and swing lows and drawing parallel lines between those swing highs and swing lows. So we've looked and identified several different ways of putting these different levels on our chart. But the more times that price bounces off support and falls back to resistance, the stronger these support and resistance levels become. The more those historical patterns repeat themselves, the more traders know and the more confident they become in forecasting the future behavior of an asset. Some prices become so entrenched in this trading range that the asset eventually has a hard time breaking through the level to either the up or the downside. So understanding the concept of support and resistance, as well as trading ranges, breakouts, and breakdowns, can be quite valuable to all traders. Support and resistance is one of the strongest and most dependable tools available to a trader. Remember that it's best to use any tool along with other indicators when deciding whether and when to take or exit a position. Support and resistance analysis is an important part of trends because it can be used to make trading decisions and identify when the trend is reversing. For example, if a trader identifies an important level of support that has been tested several times but never broken, he or she may decide to take profits as the price moves towards that point because it's unlikely that it will move past that level. So remember, there are many ways to achieve this, and understanding this concept is not difficult. It's a matter of learning to work with your charts, putting prices on your charts, and getting your hands dirty. Drawing these lines on your charts and getting familiar and understanding the personality of the asset. And the more you'll find that the more times you actually draw lines on charts and look for these prices using eyeballing or pivot points or Fibonacci levels, or swing highs and swing lows, will make you more familiar with how price is moving and how it should react as it's moving in an uptrend or a downtrend. So on that note, I'm going to say goodnight to you all. Hopefully this is the third part of your foundations. After you've got understand reading your charts, understand how to draw trend lines, putting support and resistance and volume on your chart, you're ready to go. So these are concepts you need to practice. But just remember, support and resistance levels are key mile markers in a security's progress. Whenever you're developing a trading strategy, consider these points on the chart. Doing so will help you set profit targets and prevent frustration when eventual reversals occur. Support and resistance levels also can be used as entry alerts, as where to put your take profit points, as well as where to put your stop losses. So thank you very much for joining us. Support and resistance doesn't have to be confusing. You can mix and match any of the methods and create a healthy amount of price levels that you can trade. As always, practice is what will make you perfect. Thank you very much. Thank you for supporting ETX, and have a great trading week. Good night now.